When people think of finance and investing, they think stocks. Stocks are a vital part of our economy, and they can be very intimidating to understand. By the end of you watching this video, that will change. My name is Drew, and this is Common Sense. There are two main types of stocks in the stock market. These are common and preferred stocks. Common stocks make up most of the stocks in a stock market. This type of stock gives you one vote per share to elect the board members of the companies they are invested in, who oversee the decisions by the management of the company. Preferred stocks, on the other hand, do not have the same rights to its investors. There are many different classifications of stocks, but they are really split up into three different categories. These are growth, value, and income stocks. A growth stock is a stock where the company may have potential for growth in the foreseeable future. They may grow faster than the overall markets, and they devote most of their current revenue toward future growth and expansion. Every sector of the market has growth companies, but they are more common and thrive in some areas like alternative energy, technology, and biotechnology. A growth stock basically can give you a substantial return for your investment, but also they could give you more risk towards losing your money on your investment due to many growth stock companies are small and less stable. There are obviously exceptions, but it is a good idea to research in all companies that you're interested to invest into to avoid a significant loss. Next is value stocks. These stocks are traded at a value lower than it appears it should be based on its financial status and technical trading indicators. It may have high dividend payout ratios, which simply means that a company gives more money back to its shareholders, most likely making the company's stock grow more slowly. The stock price may be lower due to the public's perception of the company, such as a scandal. This means a great time for smart investors to buy, as after some time, the public will eventually forget about the event and the stock will return to its previous value. So a value stock, in simpler words, means that the stock may be undervalued, but if you do your homework, you may earn a positive return by investing into a value stock from them growing at a slower rate. Lastly is income stocks. This type of stock pays on a regular basis. These stocks are mostly stable and typically have lower volatility, meaning it has steady growth and decline. A good way to think of this is that high volatility stocks are peaks and valleys with very sudden positive or negative growth, and low volatility stocks are hills with steady positive or negative movement. Income stock based companies rely less on using their money for growth, but instead giving the money back to its investors. So you may earn a positive return, but you may not earn profit at a very fast rate. So that is about it for the basics of the three main types of stocks. There are other classifications and terms for stocks, so if you want a particular term for stocks or any other financial term explained in a video, be sure to request it in the comment section down below. Thanks for watching. If you'd like to subscribe to our channel for more awesome videos, click here. If you would like to see our last video, click here. Lastly, if you'd like to see our awesome website, click here. Thanks again for watching. I am Drew from Common Sense, and cue the outro.